In the vast world of financial markets, options trading is an intriguing and potentially lucrative investment strategy. Options provide traders and investors with unique opportunities to profit from price fluctuations in various assets, including stocks, commodities, and currencies. Our discussion today aims to provide a basic overview of options trading, demystifying its key concepts and terminology. So what are options? Options are financial derivatives that grant the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a specified time frame. To understand options trading, it's essential to be familiar with the following key terms. Strike price. The strike price is the predetermined price at which the underlying asset can be bought or sold. Expiration date. This refers to the date on which the option contract expires. Premium. The premium is the price paid by the option buyer to the option seller to acquire the option. In the money, at the money, and out of the money. These terms describe the relationship between the current price of the underlying asset and the strike price. There are two primary types of options contracts, a call and a put. A call option provides the holder with the right to buy the underlying asset at the predetermined price, known as the strike price, before or on the expiration date. A put option, on the other hand, gives the holder the right to sell the underlying asset at the strike price before or on the expiration date. Options can provide traders with numerous strategies to tailor their risk and reward profiles. Here are a few basic options strategies. Buying calls or puts. Traders can purchase call options if they expect the price of the underlying asset to rise, or put options if they anticipate a decline. Covered call. This strategy involves buying shares of the underlying asset and simultaneously selling call options against those shares. Protective put. In this strategy, an investor buys put options to protect their portfolio from a potential decline in the value of the underlying assets. Spreads. Option spreads involve simultaneously buying and selling multiple options contracts to create a more complex risk and reward profile. We will dive into the details of these strategies in later videos, so make sure to subscribe. Meanwhile, check out the links in the description below to follow our blog and find more ways to maximize your profits.